morning, and welcome to On the Money right here on WDBO AM 580, always streaming inside your WDBO app. This is your chance to hop on the air with some certified financial planners with the Certified Financial Group. Joining us on the air today, we got Nancy Hecht and Aaron Bert, as they have been on the air for over 30 years. Not those two specifically, but the reliable voices of the Certified Financial Group has been partnering with WDBO and the audience in the Central Florida area and now all over the country and the world. But for over 30 years, they've been on the air answering your question, handing out some financial advice to help you get through, so to help you get to and through retirement. Nancy, Aaron, how are we doing today?
Pretty good.
Doing great. How are you doing, Josh?
Doing just fine.
Yeah, it's a lovely day out here in Central Florida. A little warm. We're hoping for some maybe not so much thunderstorms today. Yesterday, we felt, Nancy and I were just talking about, looked like it was really threatening for a while, but we didn't really get that much rain. We could really use it, but just hate those thunderstorms nowadays. As we head into the summer, of course, they're going to be normal activity for us, but we're not here to talk about weather. We're here to talk about your personal financial situation. So Nancy and I and the other 15 certified financial planner professionals here at the Certified Financial Group have been taking calls on the air, answering your questions about your personal situation, whether you want to talk about retirement, Social Security, taxes, investment planning, building out your portfolio, Social Security, long-term care, insurance, health insurance, all those things that are on your mind as you approach those years of accumulation and eventual decumulation through your retirement planning. And so we are here today to take your questions on the air. And fortunately for you, there is nobody on the lines right now, but we do have some numbers that we can give out, right, Josh?
That's right. If you want to join the conversation, the number to call in is 844-580-9326, 844-580 WDBO, or you can send in your question using the open mic feature inside the WDBO app. Open up that app, find the bottom right-hand corner. There's a button that says open mic, record it in, and I'll push play as if you're sitting here in studio with us. The topic of today's show is FAQs about RMDs.
So a couple weeks ago, I talked about the qualified charitable distributions when people have to make their required minimum distributions. That's what RMD stands for. And I've been working with all my other clients that are now qualified for having to take them. I have a lot of clients that are first-time RMD people. And I'm getting a lot of questions as to where do I take it from and why do I have to do this? And so I thought it might be interesting to dig into it a little bit deeper. So this was not something that anybody had to do prior to 1974. And I'm wondering, Aaron, do you know what IRA stands for?
I thought it stood for individual retirement account.
It was actually individual retirement arrangements.
Arrangements. Okay. All right.
But we got rid of the word arrangements.
Yeah, that doesn't quite fit what we do on a day-to-day basis. Okay, go ahead.
So that's what was the creation of that act in 74, which allowed people to put pre-tax dollars away for their retirement. And as the years have gone on, the amounts of money that people have been allowed to save pre-tax, or now we have Roth contributions that people can do through their employers or on their own, have been put into place. So the first required minimum distributions started actually in 2019, and it was 70 and a half.
That was the age at which you had to start taking a required minimum distribution.
Yes.
Was 70 and a half.
Yes, and there was a table that was put into place that gave a percentage based on from age 70 and a half. I think it goes up to like 115.
Yeah, that's
for age.
Yep.
And it lists the percentage that everybody must withdraw from their pre-tax qualified retirement accounts and not have to pay a penalty.
Wait, so let me get this straight. So for our listeners out there, you're putting money, you have an individual retirement account or a 401k or any sort of pre-tax account that you've been putting money into.
Yes.
You've been accumulating that money all your life.
Right.
You stop working. And now you have to take a required minimum distribution.
And pay taxes.
And pay taxes.
Because you have to pay taxes.
Because the government wants their money.
Because, it's as a recent former president said, sometimes, it's not fair to people to accumulate all that money without paying taxes
on it.
But there's been changes, and some of the changes have been beneficial. One thing that has not changed is the percentage that has to come out associated with each age. When that table was put in place, it really has not changed. So the Secure Act came in 2019, which changed the age to 72. And then we had Secure Act 2.0, which changed the retirement distribution age to 73, and that happened in 2023. And that's going to stay in place for the next 10 years. And then in 2033, the minimum age for withdrawal is going to bump to age 75.
So if I recall, anyone born 1960 or later, so if you're born 1960, 61, 62, go all the way up, your required minimum distribution age as of right now is 75 years old.
It will be, yeah.
It will be. And anyone prior to that right now is basically 73.
Yeah. And unless there's some change, who knows?
You know, it's funny. I was talking with a client about this the other day about required minimum distributions, because that's what we do in our meetings, is talk about how to take money out of accounts. And I had a dream that they got rid of the required minimum distributions.
Oh, really? Okay.
And he made fun of me that I dream about RMDs.
Well, sometimes we can't get this out of our brains, but
You just think about these things all the time, and because when it's such a part of what your day-to-day activities, it just sticks in your mind.
And especially over the last couple of weeks. So it did surprise me when I started letting my clients know how much they had to take out this year. How many people didn't realize that they actually had to do it? So I had to explain, this whole law that we just went over. And then we have a number of clients that have a variety of different accounts. Most people have traditional IRAs. Or if they had the IRAs from a former employer, it's a rollover IRA. We have some clients that have SEP IRAs, that's self-employed pension IRAs. And those are all with the pre-tax dollars. The pre-tax dollars right now are the ones that are subject to these required minimum distribution rules that we're talking about. So I have a client that has 4 different accounts that are subject to required minimum distributions. So once we calculate how much has to come out in total, the question is, where do you take it from? And it really doesn't matter which account you take it from, as long as the dollar amount is proper. So sometimes people take their required minimum distributions a little bit from each account. Sometimes they take it all from one account. And again, the dollar amount that comes out is what's important, not where it's coming from. However, one caveat is, if you have a 401k and you're making traditional 401k contributions versus Roth 401k contributions, and you're above required minimum distribution age and are still working, that account is not subject to the RMD rules.
It's the still working exemption.
Right. Yes. So there's a little bit of a break there on that side. So a lot of people are wondering, can they just convert the money to a Roth and not have to do it, which would be really cool if you could. However, you have to satisfy your RMD before you do any type of Roth conversion. One way or another, that money is going to be taxed. So that has to be done. Generally, once the money goes into a Roth account, as long as it's been there for at least 5 years, or the account has been established for 5 years, any withdrawals come out tax-free, except if you inherit a Roth account. And then you have, since 2019, you have 10 years to withdraw all the funds from that account. There's no taxation on it because it is a tax-free account, but it cannot remain as it was. There's no such thing as an inherited Roth account that could go on
forever and ever
in perpetuity. So.
Yes, so that was one of the things they did when they changed the RMD age. Yes, they pushed the RMD age out. However, they got rid of what we call the stretch IRA, which allowed you to stretch out. If you inherited an IRA, you could then take money out of that IRA over your life expectancy. So if one of my children inherited my IRA, they could take out a little bit every year over their life expectancy. When they pushed back the RMD age, they got rid of the stretch and they created this new 10-year rule, which requires certain beneficiaries to withdraw the entire account balance within a 10-year period.
And it doesn't mean that you have to make annual distributions. You just have to have that account emptied out by the time you hit that 10-year marker. So, I mean, you have to be careful then who you're naming as beneficiaries on your account.
Yeah, and they still have the at least as frequently as rule, which means that if you inherited an account and the person was already taking RMDs, they still have to continue that RMD schedule. But that whole account does have to be emptied out within that 10-year period. So there are a lot of rules now around inheriting IRAs, which are very specific. So if you're inheriting an IRA, I suggest you talk to a professional or somebody who knows what the rules are around that. You can call us, and we can help explain and walk you through what your different options are, because they are very different than they used to be, just 5 years ago.
And one thing I'm noticing, when dealing with people's retirement accounts as well as their non-retirement accounts, and having to deal with these withdrawals and then succession, is many people will have a primary beneficiary listed on their account and they will have no contingent beneficiaries. Oftentimes, a primary beneficiary is a spouse. Oftentimes, spouses travel around the world together. If some idiot on the road changes the trajectory and there's no contingent beneficiaries, then this account has to go through probate. And we want to avoid probate for our clients as much as possible.
Exactly.
It's painful, it's costly, and one of the things that you don't want to have to deal with when you're dealing with the death of your loved ones is trying to move their retirement accounts out into your name. So then you can start taking required minimum distributions.
It's true. It's true. One thing I want to circle back to that you had said about converting your RMD to Roth. You cannot, you're obviously right, you cannot convert your RMD to Roth. However, any amount above and beyond that, you can convert. So,
Right.
For example, if your required minimum distribution is $10,000 this year, you're required to take that $10,000. You cannot convert it to Roth. However, if you wanted to take 15 out, you could convert 5 to Roth, and the other 10 obviously satisfies your required minimum distribution.
And we're really, I just worked on a formula for one of my clients that wants to start doing that. So going forward, her RMDs are smaller. So I had her send me her tax return so I could see what her adjusted gross income is, adding the RMD onto it. How much could we convert after she satisfied the RMD to keep her within the same tax bracket
Right.
and not move her into a higher tax bracket?
Right. And then there's some rules, if you have spouses of different age, maybe you're taking more out of one account in order to get as much out of that account while they're at different ages before the other spouse starts RMD. This is all part of the planning that we do day in and day out for clients to balance, how much they can take and still keep in certain tax brackets.
Right.
So
Yeah,
I do
we're-
hear the bumper music,
We're
though.
really tax adverse.
Yes. I hear the bumper music, so I'm guessing we're going to commercial here.
Thank you so much, Aaron and Nancy. Yeah, if you want to call in right now, you're listening, and maybe something popped into your head like Ed, who just called in. We'll get to Ed after the break. But if you want to call in, we got some open lines, 844-580-9326, 844-580-WDBO, or send in your open mic using the free WDBO app. You're listening to On the Money, where we're planning tomorrow,
Today.
with the Certified Financial Group.
9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, ooh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak, just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit, it's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy, your cholesterol is getting high. Why?
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. If you want to join the conversation, we got Aaron Bert and Nancy Hecht, two certified financial planners with the Certified Financial Group, here on the air today, guiding us through another great hour. Call in right now, open lines, 844-580-9326 is the number, 844-580-WDBO, or send in that open mic using the free WDBO app. Aaron, Nancy, what do you say we head to the phones out in the villages where
Okay.
Ed's calling in?
Let's do it.
Hi,
Ed,
Ed.
you're on the air. How you doing today, Ed?
Good morning. How is everybody?
Doing well.
Great.
What can
Thanks
we
for
do
calling
for you?
in.
Good. Listen, when this topic comes up about RMDs, I remembered when it first came up that they talked about age 74, something being at that point. I'm age 68. My wife is age 72, so next year I know she has to take her RMDs at age 73.
Mm-hmm.
But we have two separate accounts, obviously, two IRAs. So I'm going to be 74 in 2030. So I talked to Rodney about this, and he's the only one that referenced this. He referenced an article where it says that effective in age 2030, it'll raise the age. The RMD is going to be raised to 74 in 2030 and to 75 starting in 2033. And like I said, no one else has mentioned this, and it came from an article in the Wall Street Journal, I believe. But I still got 5 years, so
Sure.
I'm not going crazy over it. But have you ever heard age 74 RMDs?
No, everything that I've seen is anyone born in 1960. There's two RMD ages that I'm aware of, 73 and 75, and anyone born in 1960 or later is at 75. But like I said, or we say this all the time, anytime Congress is in session, your money's in jeopardy. So it doesn't mean they can't change it again, either make it sooner, make it later, or change the rules altogether. So
Yeah, we're going to have to ask him to share that article because I didn't hear anything about, a change
He's the only
until
one-
2033.
Yeah, he's the only one that, ever mentioned this, and it was from an article on March 29, 2022. So if you ask Rodney, then and either refute it or say, yeah, that was right.
well, it may have been 74, but before Secure Act 2.0 came out, because things change, and so that might have been the rule at the time, and then Secure Act 2.0 was actually the rule that changed it to 75. So.
Gotcha.
Because it was 72 before Secure Act 2.0. Secure Act 2.0 comes out, it changes it to 73 and then 75 for anyone born 1960 or later. So that's probably was old news.
This article references Secure Act 2.0.
Huh. Okay.
Yep. Okay.
Well, thanks for enlightening us, and we'll talk with him.
And we'll get a clarification and
Yeah.
get back to you. We'll talk about it next week on the radio. Yes, sir. Thanks for the call.
Thank you so much, Ed. If you want to call in, 844-580-9326, 844-580-WDBO. Aaron, Nancy, got about 2 minutes left here in this segment.
Okay.
Yeah, let's just talk real quick, if you don't mind, about we have Charles Curry taking calls off the air, if I'm not mistaken. If you have a topic that is, a little bit more sensitive, or you want to be on the air, talk to Nancy or myself, you can call our office number 407-869-9800. Again, 407-869-9800. If he does not answer, please leave a message. He's probably on the phone with somebody else, and he can call you right back. Again, Charles Curry is taking calls off the air, and I think we've got some workshops coming up.
Yeah, let me put in a plug for the one that's coming up June 28th. This is Will Your Savings Last a Lifetime, hosted by Gary Abley. It's going to be in our Learning Center here from 10 a.m. until noon. If you go to our webpage, financialgroup.com, there's a drop down for the workshops. I highly recommend that you make a reservation. All the workshops have been almost full capacity every single week. So financialgroup.com. June 28th, will your savings last a lifetime? Make your reservation.
If you want to do that, you can call into our office Monday through Friday and schedule that, or you can go online again to our website, financialgroup.com. I'm trying to think of what else I just blanked.
Oh,
I love doing that on the live air. All right,
I'll give you a reset.
Reset me. All right, I guess
Okay.
we'll go to the break, and then we'll come back with some more topics
we'll
on
talk after
required
the
minimum
news.
distribution or required minimum distributions.
If you got something on your brain, feel free to give us a call, 844-580-9326, 844-580-WDBO. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
Pretty mama.
Longer, a couple blocks, and have a nice piece of salmon. Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have, that's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, or we're planning tomorrow. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, but we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're Certified Financial Group, but we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, but we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now two wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, but we're planning tomorrow, today. Are you tired?
Real fiduciaries.
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. We got Aaron Bert and Nancy Hecht, two certified financial planner professionals from the Certified Financial Group, guiding us through another wonderful hour here on WDBO. If you want to join in, they got open lines, 844-580-9326. 5 days a week they have to answer these questions, but on Saturdays they do it for free. That's what they love doing here on the airwaves of WDBO. So take advantage. If you have a question, maybe your neighbor asked you something and you want to seem like the smart person with all the answers, but really you're just phoning a friend at the Certified Financial Group. Call in now, 844-580-9326, 844-580-WDBO, or you can send in an open mic free WDBO app. If your question is a little more personal or you want to just get straight to the four walls at the Certified Financial Group and skip the whole radio part. Charles Curry is taking calls off the air, and so I want you to write down this number too at 407-869-9800. That's Charles Curry, another certified financial planner with the Certified Financial Group. 407-869-9800. Aaron, Nancy, what do you say we hit one of these text questions?
Let's go for it.
Yep.
Alrighty. Rhonda wants to know. Rhonda says, what are the best ways to track my spending?
So I think outflow is the biggest problem that a lot of people deal with, because people are using their phones or just using a credit card and not really paying attention to where cash is going. Or you sign up for 20 million different services.
Yep.
And don't pay attention as to whether there's been mergers, duplications, some place that you signed up for you're not really using, or they've gone out of business. So I think one thing that's important is to look at your statements. Let's see what kind of debits are being processed against if you're using your bank account or a credit card, and make sure that each one of them is legitimate. We have something that's a little bit more old school, but when people see it, they are very astonished at it. It's we call it the blue form. It's our expense summary report, and it looks at things like personal care, pet care. Those are the two things that I hear a lot, that people are like, oh my God, I didn't even think of that. If you have a gym membership or you work with the personal trainer, there's a lot of money going out. Mm-hmm. Are you actually using that gym? Mm-hmm. So these types of things, I want people to really pay attention. I think that people get their statements monthly online for their credit cards, and they just don't even look at them. You have no idea if something's being charged or something was charged that was not yours at all. My husband, for example, had to take his car in for service, and he called for an Uber to take him home. And guess what? His account had been canceled, because when we were in Philly 2 years ago for a wedding, there was a charge for $80, which he saw because he looks at his bill and he disputed it. Supposedly, we got a ride from the airport to someplace in downtown Philly when we were already back here. Mm-hmm. So he thought disputing it and getting it taken off his bill was it, but Uber wanted to get paid. So they suspended his account. So you have to look at these types of things to make sure they are legitimate expenses. And I had mentioned duplicate charges. We're seeing in streaming, there's a lot of consolidation that's going on and buyouts between networks. So people may be signing up for something so they can see a specific movie or program, and then they never look at it again. And you don't realize how much these, $5, $10, $15 charge a month charges add up. Mm-hmm. And especially if you multiply it over 2 or 3 or 5 years. So it's really old school to take some time and look at your statements, but it's the best way to see where your money's going and tracking your expenses.
And there are lots of tools out there available for you as well. So there's, the ones that take time. I'm a little bit more, I don't want to use the word paranoid, but I'll use the word paranoid. Every day back in the day when I was in college, I started using Microsoft Money, which has since gone away, and then I converted into a Quicken user. And every day I download all my transactions into my Quicken account, and then I also then go and categorize all my transactions as well, so I have an idea of if there's any fraudulent charges coming through and where my money's going. I realize I'm a little bit overboard, but this is what I do for a living. Conversely, there's other tools out there available as well. There used to be Mint. I think Mint went away. A lot of people now, I had a client talk to me yesterday about Monarch Money. He said he's using to track all of his expenses. A lot of the banks have a lot of services as well that you can use. The credit cards themselves also have services. So it's not only looking at the transactions, but then also making sure that you're staying within some sort of budget and not running up debt, and that you're saving the appropriate amount too. And that's one of the conversations we have with clients all the time. You have this much coming in, you anticipate this much coming out. This is what you should be able to save. Are we saving that money or not? And if you're not able to save that kind of money, then you have a hole in the bucket, as we like to say, and there's leakage somewhere. And where is that leakage? And let's identify it so that we can maybe tighten that up so that we can hit our savings goals and accumulate the money that we need to accumulate. Because really the biggest challenge is if you retire, you're kind of on a fixed income and you have leakage and you can't
Right.
you don't know where it's going, and then you're running out of money and the wheels are falling off, and those are really bad situations.
And it's simply a matter of paying attention.
Right.
You know, when people actually wrote checks for everything and balanced a checkbook, you were seeing every single transaction.
Yep.
So it's just a matter of being fiscally aware of how you're spending your money.
Right, exactly. It's too easy to use
And there
Apple
are,
Pay
yeah,
or any of those
you
other
know.
services. It just doesn't.
Yes.
Yeah,
Yes.
it's a problem.
So, okay, Rhonda, you'll find something. There's a lot of sources out there.
And I will say, if anyone is interested in getting our living expense form, our blue form, as Nancy mentioned earlier, we can send that out to you. So if you're interested, you could email us at plan@financialgroup.com. Again, plan@financialgroup.com, and we can send you a copy of that form just so you can see what that looks like and maybe get an idea of maybe starting to track your own expenses. That's the form we hand every client if they end up wanting to do financial planning with us, because it really gives us a good baseline for what your living expenses are. So plan@financialgroup.com, put in the subject line blue form, and we can send you a PDF copy of that.
Thank you so much. If you want to call in, 844-580-9326, 844-580-WDBO. Next question coming in from Miles. Miles says, should I pay off my mortgage before retirement?
I'm on the fence about this.
Yeah.
If you have a
depends.
mortgage that's at, I'm going to say 3.5% interest rate or less, that's pretty cheap money. I know that if somebody's close to retirement, they're probably not getting a tax benefit for paying the interest on their mortgage, but I think it really comes down to peace of mind.
Mm-hmm.
What is going to make you feel the best? Again, how big of a balance do you have on your mortgage going into retirement versus, the money that you've accumulated? But if your interest rate is low and the payment is no big deal, then I say, why rush to pay it off? The money that you would be, putting extra towards paying off your mortgage, you could put towards maybe an emergency fund. In case something happens, or just boost up your savings. But really, in my opinion, it's a personal preference. What is going to make you feel more comfortable going into retirement, having it paid off or not?
And it also depends on where the money's coming from. So if you're planning on taking a big chunk of money out of your IRA and paying taxes on it in order to then pay off your mortgage, that clearly doesn't make any sense. One thing to remember too with the mortgages or most debt is that the interest is really front loaded. So if you're on the tail end of your mortgage, you're probably not paying that much in interest, and most of your payments are going towards principal.
Right.
So even if you do have a higher interest rate, you already paid most of that interest if you're on the tail end of the mortgage. So again, every situation is kind of unique and different, and that's part of the process that we go through, because we get this question a lot. I don't want to have a mortgage when I go into retirement. Okay, great. What's your interest rate? 2%.
Yeah.
You're going to have a mortgage going into retirement.
Well, and then one thing that we did years and years and years ago when we get this house is we started making bi-monthly payments.
Oh, yeah.
Which I recommend that almost everybody that I'm meeting with do. And what you end up doing is making 13 payments a year as opposed to 12, which really doesn't sound like much, but it can knock about 10 years off the whole life of the payment. And as long as there's no, penalty for prepaying, and you can have it maybe go a little bit more towards the interest that as opposed to the principal, then that can be beneficial also. So that's another way to shorten the life of a mortgage and then keep your cash flow within a reasonable, comfortable place.
Yeah, lots of different strategies to get the debt down. And that, again, part of the process that we go through with people when we meet with them. So, do we have any more questions, Josh? Or
Yep. We got a couple we can hit real quick if you like.
Sure. Let's do one more.
Rebecca wants to know. Rebecca says, is my money in the right places? Is it diversified properly? Am I taking on more risk than I need to?
Well, that is a common question, and I have an interesting story from something that happened last night. But we have a risk tolerance quiz that's a really, really easy quiz to take that gives us an idea of how much somebody's comfortable with having in equities, which would be stock-based mutual funds, and income, which is bond funds. And that's the first place that we start. And then we want to be diversified within the categories: mid cap, small cap, large cap, some growth, some value. So not all things are moving in the same direction at the same time. So depending on where you are at life and what your attitudes are at risk will determine if your money's in the right place. We have a family friend who's a Lake Mary police officer, and he knocked on our door yesterday to say, did you know your garage door is open? Which we did. But he really had a retirement statement in his hand and wanted to ask me some questions about it.
Sure.
And one of the things that he had mentioned is that he's really, really conservative, and he wants to keep things more into a safe place, which in my mind is bond or income types of items. And the point that I made to him is, based on his age, he's in his 30s, and how many more years he potentially has to live, he needs to boost up the stock or equity portion of the portfolio, because equities are what keep you ahead of inflation. And growth is important because we want our money to work for us, but you also want it to be there for the 10, 15, 20, 25, 30 years that you hope to live in retirement. So it's important to have a balance. What is the appropriate balance per each client may be different. But we can answer the question by a really simple quiz.
Yeah, and we get that question a lot when we meet with people too. But people think, I'm hitting retirement, I need to get conservative and not lose any money. And really, when you go into retirement at 60, let's just say at 65, you could theoretically have 20, 25 more years of living that you need to continue to have some sort of growth on your portfolio, and you can't necessarily go into a totally conservative portfolio and at least not keep pace with inflation. So again, that's part of the whole planning process that we go through with people is you say, I got this much coming in, I got this much going out, I have this much in my portfolio. If I earn this much, how do I end up? If I get more conservative, how do I end up? If I get more aggressive, how do I end up? And that's part of the conversations that we have about what the risk tolerance that they're comfortable with per the quiz that we do, and then what they feel they're comfortable with and what they can afford to do with the planning that we do. And that's part of what we do day in and day out here at the Certified Financial Group when we meet with clients and do retirement planning.
So we just discussed two of the components that are necessary for putting a retirement cash flow plan together. The expense summary and the risk tolerance quiz.
Yep, there you go.
And both of them are relatively easy to deal with from a client standpoint. So we want to make it an easy process for our clients.
And I hear more music.
You got it. If you want to call in, you're listening right now to Aaron and Nancy. You got a question for the two of them, call in right now. We got open lines, 844-580-9326, 844-580 WDBO. Also have Charles Curry standing by at the offices of Certified Financial Group. If you want to take your question off the air, that is available at 407-869-9800, 407-869-9800. You're listening to On the Money, where we're planning today with the Certified Financial Group.
Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're a Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Ooh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me.
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. If you want to call in right now, we got about 4 or 5 minutes left on the air, so we can maybe get you on the air, 844-580-9326. But after the show comes to a close, and maybe a more useful number for you to have the other 23 hours of the week, or of the day, and 6 days of the week, is Charles taking calls off the air at 407-869-9800, like your own personal rendition of On the Money. 407-869-9800, or if you want to email into the office at Certified Financial Group, there's an option for that too.
All right, we do have we do get emails regularly actually during the week, and so we had a couple emails that had come in, and one of them that we had gotten. And if you're ever interested in emailing the show, just email plan@financialgroup.com, put On the Money question, and we'll get to the question during the next weekend. The one that we got this week says, does one take the value of all IRAs for RMD calculation based on the value at the close of 12/31? And would that vary for any particular type of investment, private or public, bonds, stocks, ETFs, annuities, etc.? So how is the RMD calculated, Nancy, and what values are they taken in order to do that?
Well, the balance of the whatever kind of account that you have as of 12/31 of the previous year is what determines what your retirement your requirement of distribution is going to be. It really doesn't matter if it's in individual stocks, individual bonds, mutual funds, ETFs, private placements will also have to have a valuation, and they know if it's in a retirement account, it has to be done by December 31st of the year because people do have to follow the law with required minimum distributions. So,
Yeah, I would say they did mention annuities. So if you have annuitized your annuity, that does not require a required minimum distribution because there's really no 1231 value. So annuitization basically means you're giving up the value of the annuity in exchange for an income stream. And so if you have an annuity that you annuitize, there is no required minimum distribution required. So that's something important to keep in mind. Also, Nancy had mentioned the 401k still working rule. So if you're still working for an employer, you're not required to take a required minimum distribution from that account as well. So something else to keep in mind. The caveat to that is if you're a 5% or greater owner, you are required to take an RMD. So make sure you keep that in mind. If you're an owner of a company that has a 401k plan, you still are required to take a required minimum distribution from that as well. So,
and we have a few workshops coming up. I want to make sure that I mention them. I had mentioned Will Your Savings Last a Lifetime, hosted by Gary Abley on June 28th from 10 until noon. After that is Savvy IRA Planning for Boomers, Strategies to Help You Save Taxes and Get More Out of Your IRA. This is hosted by Dave Balakrishnan. This is going to be on July 12th from 10 to 11:30 in our Learning Center. And then Tax Efficient Investing and Distribution Strategies, hosted by Gary Abley. This is going to be at Village on the Green on the 26th of July. So the workshop will be from 10 until noon. And I'm assuming that the radio show is going to be broadcast live from 9 until 10.
Yep.
So if you want to participate in the audience for that and then stay for the workshop, you can do that. Again, you can find all of our workshops listed on our webpage, financialgroup.com. There's a there is a workshop pull down that you can make a reservation, or again, you can call the office and ask if you can make a reservation for one of the workshops.
And there's absolutely zero cost to go to any of our workshops. And the reason we do that is really just to have a introduction to us and our company. Leave your checkbook at home, as we like to say. It's to provide education to the general public. You get comfortable with us and hopefully provide you with some great information. And especially the Village on the Green is going to be a hot one. So if you're interested in attending that one, make sure you do that early because that one will definitely fill up fast.
We hope everybody has a great weekend.
Thank you so much, Aaron Bert and Nancy Hecht, 2 certified financial planners with the Certified Financial Group. Charles Curry, a 3rd certified financial planner with the Certified Financial Group, taking calls off the air after this show comes to a close. Pick up the phone, dial in 407-869-9800, 407-869-9800. You've just listened to On the Money, where we're planning tomorrow
today
with the Certified Financial Group.